So you're sitting there. You've got $30,000 in student loans, maybe another $8,000 on a credit card, and every financial guru on the internet is screaming at you to pay it all off as fast as possible. Meanwhile, you just read that Jeff Bezos took out a loan to buy a $175 million mansion, and you're thinking, wait, what? The richest people in the world are borrowing money, while I'm being told debt is the enemy. Yeah, that's because nobody's explaining to you that there are actually two completely different types of debt, and one of them is quietly making wealthy people richer, while you're losing sleep over yours. My name is Arthur, and I spend way too much time thinking about why we're taught to fear debt when the wealthy are literally using it as a tool to build wealth. If you're someone who's been taught that all debt is bad, that you should pay off everything before you invest, or you're confused why billionaires are taking out loans they could easily pay cash for, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. We have a massive problem with how we talk about debt in this country. We treat it like it's all the same thing. It's like saying food is either good or bad. Well, is it broccoli? Or is it a deep-fried Twinkie? Because those are very different things, right? According to the Federal Reserve's 2024 data, the average American household carries about $104,000 in debt. Now, when you hear that number, you probably feel a little sick to your stomach. But here's what most people don't realize. That number includes mortgages, and wealthy people, they carry even more debt on average. A study from Spectrum Group found that households with over $5 million in net worth carry an average of $1.5 million in debt. So what's going on here? Are rich people just bad with money? Obviously not. They understand something fundamental that most of us were never taught. Look, there are two types of debt, and this is where everything starts to make sense. There's consumptive debt and productive debt, and the difference between these two will literally determine whether you build wealth or stay broke for the rest of your life. Consumptive debt is debt you take on to buy things that lose value or generate no income. That $40 dinner you put on your credit card? Consumptive debt. The $35,000 car loan at 7% interest for a vehicle that loses 20% of its value the second you drive off the lot? Consumptive debt. That 72-inch TV you financed at Best Buy? You get the idea. Productive debt is debt you use to acquire assets that either appreciate in value or generate income that exceeds the cost of the debt itself. A mortgage on a rental property that generates $1,800 a month, while the mortgage costs you $1,200. That's productive debt. A business loan at 6% that lets you buy equipment to increase your revenue by 30%. Productive debt. A low-interest loan to invest in an asset that returns 10% annually. Also productive debt. Now you might be thinking, okay Arthur, but isn't it still safer to just avoid debt altogether? And that's exactly the mindset that keeps people from building wealth. Let me show you why with some actual math. Let's say you have $100,000 saved up. You're looking at buying a rental property, and you have two options. Option one, you pay cash for the entire property. No debt. Feels safe, right? That property generates $12,000 a year net rental income after all expenses. That's a 12% return on your $100,000. Pretty good. Option two, you put $25,000 down and get a mortgage for $75,000. That's 6% interest. Your mortgage payment eats into your rental income, so now you're only netting $6,000 a year from that property. But here's where it gets really interesting. You still have $75,000 left over. You take that remaining $75,000 and buy 3 more properties using the same strategy. Now you've got 4 properties generating $6,000 each. That's $24,000 a year versus the $12,000 you'd make paying all cash. Same initial capital, same amount of your own money at risk, but you're making double the income. And that's not even counting the fact that you now own 4 appreciating assets instead of 1, and your tenants are paying down 4 mortgages instead of 1. This is what wealthy people understand. They use leverage, which is just a fancy word for debt, to multiply their returns. But here's the critical part. They only use it on assets that produce income or appreciate in value. So why are we so terrified of debt? Well, there's actually a really good reason for this, and it's important to understand the psychology here. For most people, their only experience with debt is the bad kind. You grew up watching your parents stress about credit card bills. Maybe you saw a family member lose their house in 2008. You've been hit with overdraft fees, late payment penalties, collection calls. Every interaction you've had with debt has been painful. So your brain creates a simple rule. Debt equals pain. Avoid all debt. And for consumptive debt, your brain is absolutely right. That rule will save you from financial disaster. But here's what happens. We overgeneralize. We take that rule and apply it to all debt, including the debt that could actually make us wealthy. It's like if you got food poisoning from bad chicken and then decided to never eat protein again. You're protecting yourself from one problem, but creating a much bigger one. There's actually a term for this in behavioral economics. It's called loss aversion. Research by Daniel Kahneman, who won a Nobel Prize for this work, shows that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining it. So when we think about taking on debt, even productive debt, the fear of loss dominates our decision-making.
This is why you'll meet people who are sitting on $50,000 in cash, earning 4% in a savings account, while they have a mortgage at 6.5% they could pay down. The math says, pay off the mortgage. You're losing 2.5% every year. But the emotional comfort of having that cash, just in case, overrides the rational decision. Now, let's go back to that example I mentioned at the beginning. Why would someone like Bezos, who could literally write a check for $175 million, take out a loan instead? Here's what most people don't realize. When you're wealthy, your money is working for you in investments. Bezos doesn't have $200 billion sitting in a checking account. It's in Amazon stock. It's in his space company, Blue Origin. It's in investment funds returning 10 to 15% annually. So let's say he can get a loan at 4% interest. And trust me, when you're worth $200 billion, banks are offering you amazing rates. Why would he pull money out of investments earning 12% to pay cash for a house when he can borrow at 4% and keep his money earning that 12%? The math is simple. He's making an 8% spread on a $175 million loan. That's $14 million a year in additional return every single year, just by understanding how to use debt strategically. And here's the kicker. That interest he's paying on the loan, if it's structured correctly, there's a good chance it's tax deductible, which makes the effective interest rate even lower. This is how the wealthy think about money. They're not asking, how do I avoid debt? They're asking, what's the cost of this debt versus the return on my capital? Look, here's where people really mess up, and I see this constantly. They focus so much on eliminating debt that they miss massive opportunities. Let's say you have an extra $1,000 a month. You've got a student loan at 4% interest and about $30,000 remaining. The standard advice says throw all that extra money at the loan. Pay it off in 2.5 years instead of 6. Feels great, right? You're debt-free. But what if you took that same $1,000 a month and invested it in an index fund, averaging 10% returns? After that same 2.5 years, you'd have about $33,000 in investments. After the full 6 years, when the loan would naturally be paid off anyway, you'd have nearly $95,000. Even accounting for the interest you paid on the loan during those extra 3.5 years, you're tens of thousands of dollars ahead. But more importantly, you've built an investment habit. You've got a growing portfolio. You understand compound interest is working for you instead of just trying to minimize it working against you. This is the opportunity cost nobody talks about. Every dollar you throw at low-interest debt is a dollar that's not growing for your future. And time is the most valuable asset you have when it comes to building wealth. Now this is where it gets really interesting, and it's going to sound completely backwards at first. Having and responsibly managing debt actually improves your ability to borrow money when you really need it. Someone with zero debt and someone with $0 to their name look surprisingly similar to a bank. Neither one has a proven track record of managing credit. Your credit score, which determines what interest rates you'll pay and whether you'll even be approved for productive debt, is built on your history of managing debt. According to FICO, 35% of your score is payment history, and another 30% is how much debt you have relative to your credit limits. I've seen people pay off all their credit cards, close the accounts, and watch their credit score drop 50 points because they suddenly had no credit utilization and lost years of credit history. Then, 6 months later, they want to buy a rental property, and now they're getting quoted 7.5% interest instead of 5.5%. On a $300,000 loan, that's an extra $6,000 a year. Over 30 years, that's $180,000 in additional interest, all because they didn't understand how strategic debt management works. The wealthy keep revolving lines of credit open. They maintain relationships with lenders, and they have proven track records of managing large amounts of debt. When a great investment opportunity shows up, they can move on it immediately with favorable terms. Okay, so here's the thing. I'm not saying go out and take on a bunch of debt tomorrow. That would be stupid, and you'd end up broke. There are very specific rules for using debt strategically, and if you break these rules, you will absolutely destroy your financial life. Rule number 1, never use debt
for consumption. If it loses value or doesn't generate income, you don't finance it. That means no credit card debt for restaurants, vacations, or clothes. No car loans, unless the car directly generates income for you. This is non-negotiable. Rule number 2. The asset must generate returns higher than the cost of debt. If you're borrowing at 7%, whatever you're buying needs to generate more than 7% in returns or income. And honestly, you should aim for at least a 3 to 4% spread to account for risk and unexpected expenses. Rule number 3. You must have an emergency fund first. Before you take on any productive debt, you need 3 to 6 months of expenses in cash. Because if something goes wrong, you lose your job, the market crashes, whatever, you need to be able to make those debt payments without going into a panic spiral. Rule number 4. Never over-leverage. Just because you can borrow 100% of an asset's value doesn't mean you should. Wealthy people typically aim for a loan-to-value ratio of 70 to 80% max. That equity cushion protects you when things don't go according to plan. Rule number 5. Have a plan for the debt. Every dollar you borrow should have a specific purpose and a clear path to generating returns. I might use it for something good is not a plan. So let's get practical. How can you actually apply this if you're not a billionaire? Here are some real-world examples. Example 1. The house hack. You buy a 3-bedroom house with an FHA loan requiring only 3.5% down. You live in 1 bedroom and rent out the other 2. If you structure this right, your tenants cover most or all of your mortgage. You're living essentially rent-free while building equity in an appreciating asset. This is using debt to acquire an income-generating asset while reducing your cost of living. Example 2. The business launch. You have a side business idea that requires $15,000 in startup capital. Instead of saving for 2 years, you take out a low-interest business line of credit. You launch 6 months from now instead of 2 years from now. That business generates $3,000 a month in profit. Even after the loan payments, you're cash flow positive within 6 months, and you've gotten an 18-month head start on building your business. Example 3. The refinance strategy. Your house is appreciated, and you have $100,000 in equity. You do a cash-out refinance, pulling out $70,000 at 6% interest. You use that $70,000 as down payments on 2 rental properties that each generate a 12% cash-on-cash return. You're making 6% on borrowed money. That's free money. Example 4. The educational investment. You have an opportunity to take a certification course that costs $8,000, but will increase your income by $20,000 per year. Even if you borrow that $8,000 at 8% interest, the return on investment is immediate and massive. You'll pay back the loan in less than 6 months and be earning an extra $20,000 plus annually for the rest of your career. Now, you might be thinking this all sounds great, but let me tell you where people screw this up, because they do it all the time. Mistake number 1. Using productive debt principles to justify consumptive debt. Well, Arthur said debt is good, so this $50,000 truck is fine. No, the truck loses value every single day. It generates no income. This is the exact opposite of what I'm talking about. Mistake number 2. Overestimating returns and underestimating costs. Everyone's a genius investor when they're running projections, but real life includes vacancies, repairs, bad tenants, market downturns, and unexpected expenses. Build in margins of safety, or you'll end up over-leveraged and stressed. Mistake number 3. Treating a house you live in as an investment. Your primary residence is not an investment in the traditional sense. Yes, it might appreciate, but it generates no income and costs you money every month in maintenance, taxes, and insurance. A mortgage on your primary residence is better than paying rent, but it's not the same as productive debt on a rental property. Mistake number 4. Ignoring interest rates. In a high interest rate environment, the math changes. If you're borrowing at 10% to invest in something returning 8%, you're moving backwards. The rates matter enormously. Mistake number 5. Getting emotional about debt payoff. Look, I get it. There's a psychological win to being debt-free. But if that feeling costs you hundreds of thousands of dollars in missed investment returns over your lifetime, was it really worth it? Make financial decisions based on math first, emotion second. Here's what this actually looks like over a lifetime. And this is what separates people who build real wealth from people who just stay comfortable. Let's track 2 people, both starting with the same income at age 30.
30. Person A follows traditional advice. They aggressively pay off their $40,000 in student loans over 5 years. Then they save up and buy a $300,000 house with a 20% down payment in cash. Takes another 4 years. They eventually invest, but they don't really start building a portfolio until they're almost 40. Person B takes a different approach. They pay the minimum on their 4% student loans and invest the difference. They buy the same house at the same time, but with only 5% down, investing the rest. They use a HELOC later to invest in a rental property. By age 40, they still have the student loan debt, but they also have a growing investment portfolio and 2 properties building equity. According to research from the National Bureau of Economic Research, Person B will typically end up with 2 to 3 times the net worth of Person A by retirement age, even though they carried more debt throughout their life. The reason? They understood that debt is a tool, and they used it to accelerate wealth building during the most important years, their 30s and 40s, when compound interest has the most time to work. We need to talk about taxes, because this is where productive debt becomes even more powerful, and most people have no idea this exists. When you borrow money to invest in income-producing assets, the interest you pay is often tax-deductible. So if you're in the 24% tax bracket and you're paying 6% interest on a loan, your effective interest rate after the tax deduction is actually only 4.56%. Meanwhile, that same investment property is generating depreciation deductions, even though it's probably appreciating in value. So you're getting cash flow, you're building equity, your asset is likely increasing in value, and you're reducing your taxable income. This is why real estate has created more millionaires than probably any other investment vehicle. The wealthy structure their debt specifically to maximize these benefits. They're not just thinking about the interest rate, they're thinking about the after-tax cost of the debt versus the after-tax return on the investment. Look, here's what I need you to understand. The difference between people who build wealth and people who don't isn't intelligence, it's not luck, and it's not just about income. It's about understanding how to use financial tools, and debt is one of the most powerful tools available. Every single month, you're making a choice. Either your money works for you, or you work for your money. Productive debt is about making your money work harder, grow faster, and create more opportunities than you could ever create with just cash alone. But, and this is important, this only works if you're disciplined. If you're currently carrying credit card debt, if you're financing depreciating assets, if you don't have an emergency fund, then your first step isn't to go take on more debt. Your first step is to get your financial house in order. Build that foundation first. Once you have that foundation, once you understand the difference between productive and consumptive debt, once you can run the math on returns versus costs, that's when you can start using debt as a wealth-building tool instead of a wealth-destroying burden. The wealthy aren't smarter than you. They just learned these principles earlier, usually because someone taught them, or because they had access to financial education that most of us never got. But now you know. The question is, what are you going to do with this information? Are you going to keep following advice designed to keep you comfortable but broke? Or are you going to start thinking like the people who actually build wealth in this country? If this video changed how you think about debt, hit that subscribe button, because we're going deep on financial strategies that actually work. Drop a comment and let me know. What's one way you could use productive debt in your own life? And if you found this helpful, share it with someone who needs to hear this message. Your financial future isn't determined by how much debt you avoid. It's determined by how well you understand which debt to take on and which debt to run from. I'll see you in the next one.